So we're going to be going over IRS Form 433A. This is the collection information statement for wage earners and self-employed individuals. So you would be using this in conjunction with IRS Form 656, known as the offer in compromise. So let's take a step back. When you submit an offer in compromise to the IRS, that offer in compromise has to be accompanied by a collection information statement. And basically, what that means is the IRS wants to know a little bit more about your financial situation. They want you to report basically everything about your situation, from your assets and liabilities to your income and expenses, and they want to reserve the right to take a closer look at anything that may have an impact on your offer in compromise. So an offer in compromise is it's a proposition where the taxpayer might owe a certain amount of taxes, and the IRS is willing to accept a lower amount of payment so as to not create a financial hardship and also to collect some money. So if you owe, say, $100,000 and you're able to substantiate that you can only afford to pay $50,000, well, you would submit the offer in compromise that says, hey, I can pay $50,000, and then the collection information statement would serve to justify why you can only pay $50,000. And then the IRS will evaluate this. They'll either agree with your assessment, they might ask for some additional information or some additional documentation, or they might disagree and say, hey, we've reevaluated this and we feel you can pay a little bit more. So this is the first step in getting to that conclusion. And ultimately, you do want to have some offer that's accepted by the IRS in a way that doesn't leave you completely in a financial hardship. So the collection information statement serves to do just that. Now, you should use this form if you are an individual that owes taxes on a Form 1040, like an individual income tax return. If you're a person with personal liability for an excise tax, if you're responsible for a trust fund recovery penalty, if you are self-employed or have self-employment income, and that would be if you're filing Schedule C, if you're in business for yourself, or if you have a business on the side, you can call it a side hustle, gig economy work. There's tons of names for it. Basically, self-employment is any income that you've earned that isn't reported to you on a Form W-2 at the end of the year. You would also file this if you're an individual who's personally responsible for a partnership liability, but only if the partnership is submitting an offer. In that case, the individuals behind the partnership would have to submit that offer as well, or the collection information statement behind the offer. And finally, if you're an individual who's submitting an offer on behalf of the estate of a deceased person. So there are 10 sections to this. This is an 8-page document, so it's not a short form, but we have taken some steps to try and condense this as much as possible so that you get the basics and you can move quickly through this video. So in section 1, we're going to go over personal and household information. So as you see here, we've got our hero John Doe, first name, last name, his date of birth, social security number. He happens to be married. His spouse's name is Mary Doe. They own a home. It's in Texas, so we check this box. This box basically means it's letting the IRS know that you live in a community state. Community property state. So there are different laws of ownership when it comes to community property. This is simply something that the IRS can account for when trying to gather information about your situation. It doesn't really have an impact on whether or not the IRS will accept your offer in compromise or not, but it may have some consideration as to what would be considered separate property and what would be considered community property, and that would possibly apply to certain circumstances where one spouse is responsible for a tax debt, but not necessarily both. So, county of residence, phone numbers, information about Mary Doe, and then they have a daughter, Elizabeth. We've checked this information here. They do claim her on as a dependent, but she does not contribute to household income. So it's important to list everyone in your house because the IRS will want to know if they chip in to help pay rent or put groceries on the table, things of that nature. So in this case, it's a husband and wife. They've got a 15-year-old daughter. In section 2, this is employment information for people that receive a W-2. If you have self-employment income, you would not put that information here. You would go to section 4, 5, and 6 to complete the business information. And we will go through that in a moment. So in this case, John Doe works for Acme Enterprises. He's paid bi-weekly. There's the employer's address. It's out in town. He does not have an ownership in the business, but if he did, he would have to complete and submit IRS Form 433B, which is the collection information statement for businesses. He's an engineer and he's been with the company for 10 years. Mary does not work outside the home, but if she did, we would put her information here in a similar fashion. We'll find that she actually has a side hustle, and we'll get to that in section 4. In section 3, this is all about their personal assets. So this goes for a ways. We're going to each of these lines has a specific meaning. So first, we're going to go through cash and investments. So literally all of these different cash liquid investments. So if you owe $10,000 and you're reporting to the IRS that you have $10,000 in your bank, I'll give you some informal advice. They're probably not going to accept an offer in compromise. So just kind of keep this in mind. Like as you're reporting it, you do have to be truthful because you will sign this document under penalties of perjury. But this is also a forcing function to really kind of get you to accept what the IRS may or may not be willing to consider. So in this case, they've got a checking account and a savings account at Acme Savings Bank. Here's their account information. They've got $10,000 in each account. And then if you have more than the amount of accounts that you can list here, you can add attachments. So you can put in an Excel spreadsheet or Word document, however you want to frame it. There's not a specific format. It just needs to contain the same required information as you've seen here. So something that reports the type of account or asset, the name of the financial institution, the account information. That's what you would need. So if you have 10 accounts, you should have a document that says 8 different types of accounts, all their account balances, their account numbers, and then you would enter the total of those here. So we've got $10,000 in account 1, we've got $10,000 in account 2, we've got $10,000 across all the other accounts reported on an attachment. So that's $10,000 right there. We total that up, and that's $30,000. So you'll notice the line naming convention. All of these supporting lines, like 1A, 1B, 1C, add up to line 1. Now keep this in the back of your head because we're going to total all of the lines at the end of section 3, except we're only going to total the lines that don't have letters in them. So anything like 2A, 2B, 2D, 3A, so on. We're not going to use those for our section 3 calculation. We're simply going to add line 1, line 2, line 3. So that's why these are highlighted in bold. So when you go back to tally up your totals, it's a little bit easier to get the required information. Just kind of keep that thought in mind. All right, in this next section, annotated by line 2 at the bottom, has to do with investment accounts. So unlike liquid assets like your checking and savings account, investments do fluctuate in value. So we'll kind of walk through what that means. Let's say that they've got an investment account at Acme Investments. This is account number 3. Their $10,000 market value is going to be decreased by a bit. The IRS will kind of force you into this calculation where we take 80% of that value and kind of that represents what could be liquidated if needed. So it's not a guarantee that the IRS will liquidate your assets. It's just a placeholder for the IRS to assign some sort of value, because if you had to sell your investments tomorrow to pay your tax, it might be listed at $10,000, but maybe you are selling into a market runoff or whatever the case may be, you might not get $10,000. And the IRS is going to recognize that and kind of reclassify that appropriately. So again, this is not to force any liquidations of any of your accounts. This is simply to give the IRS an approximation of how much in assets you have. So the $8,000 is here. If we had a second financial institution, we'd go through the same thing. Loan balance, if you're not familiar with margin accounts, then you probably do not have one. But investment firms do offer certain account holders the ability to borrow shares. If you've ever heard of shorting stocks, for example, those would be technically on margin accounts. So you can also borrow money if you're going to buy an investment, hope to sell it at a higher price later on. So those are margin accounts. Technically, it's a loan. If you did have a margin account balance, you would put this amount here, and then that would lower the amount of actual investments you have. So let's just imagine, for example, you had $5,000 of margin that was supporting this $10,000 investment. The IRS is only going to consider it as value at $8,000, but because you have $5,000 of margin against it, this would be decremented by $3,000. So as a pro tip or kind of a word of advice, you're supposed to report honestly, but if the assets are reported as lower than you think they should be, then that's actually a good thing in your favor. So when you look at this, don't take offense that the IRS is marking this down. This actually is working in your favor, because the lower your assets appear to the IRS, the lower your offer in compromise would need to be for it to be acceptable to the IRS. So your incentive in this is to honestly find ways to make this lower. This doesn't mean you can falsify records. It doesn't mean that you can skip any assets. You have to list everything honestly and truthfully. But be heartened when you see something that lowers the value of your assets. So if you have a margin account, be sure to remember and put that in there. Don't forget it, because that lowers your account availability honestly. We put in a digital asset. So I'm not an investor in digital assets. I kind of roughly know how they work, but let's just say that they have an investment in Dogecoin. They've got 100 units of Dogecoin that's worth $2,000. We listed the digital asset address. If you're self-hosting your digital assets, if you have it on an exchange, you could list that instead. But really, just for illustrative purposes, I wanted to attach $2,000 and then the $2,000 plus the $8,000. And let's just say that we have another attachment we would add $10,000. Again, similar format as up here. Just make sure you use these information details. So $10,000. Total of lines 2A through 2D is $20,000. So we'll refer to that later. So in line 3, we're going to be talking about retirement assets. So retirement assets, this would be your 401ks or other workplace retirement plans. IRAs would be another example. And in this case, we have an IRA at Acme Investments. This would be account number 4. And let's just say that this is worth $10,000. We're going to mark it down to $8,000 based on the IRS guidance. So that's what we put here. Let's say that we have another $2,000 in some other forgotten 401k. We've marked that offline, so we provide the attachment to go with this form, and it's $2,000. We'll add everything up, and total of our retirement assets is $10,000. So there's a note here that recognizes that when the IRS processes this form to value your assets, they may choose to actually take this down even more. Again, that's a note in your favor. The lower your assets are listed, the better it is for you. But the IRS does recognize that, if you had $10,000 in this account, even if you got a full $8,000, if you were forced to liquidate that retirement account tomorrow, you would have to pay taxes, most likely. And if you're under the age of 59 and a half, you may have to pay early withdrawal penalties. So that $8,000 withdrawal would actually be significantly less. So the IRS, when they're doing their evaluation, they may actually choose to knock that down a little bit more. I don't see any guidance as to how much they'll do that. I'd have to dig deeper into the Internal Revenue Manual to make that determination, and even that's subject to change. So I don't pretend to know the answer right off the top of my head. So we'll keep this $10,000. We'll put kind of keep that as a placeholder. Now we're going to talk about cash value of life insurance policies. So when you talk about cash value of life insurance policies, you're really talking about permanent insurance policies. So whole life, like a universal index life insurance policy, they can accumulate cash value. Policies such as a group term insurance policy, anything with a term like a 30-year term policy, is going to have a zero cash value. That's just how life insurance policy contracts are drafted. Term insurance policies, group insurance policies generally have no cash value. So if all of your insurance is a form of a term policy, you can skip this line right now. But in this case, John and Jane Doe, they have an insurance policy. We'll call this policy number 5. The current cash value, which is not necessarily the death benefit value, it's $10,000. If you had a loan against your insurance policy, which you can, you would put the loan balance here. But in that case, they don't. They have a $10,000 cash value on one policy. They have $10,000 of cash value on another policy. And so we're going to add those two together, and we've got $20,000. Again, we'll set that aside for now. So we listed that they own their home. So if you do own a home, you would have to complete this part of Section 3. They're not listing it for sale, but if you did, you could put the listing price. This is how much we expect to get, either listed price or what you expect to receive. What you expect to list it for. And in this case, this is their primary residence. They bought it in 2020. They have a $300,000 mortgage that they started when they bought the home. So their last payment is, I guess, technically 12/1/2049. And it's jointly held between the two of them. The address, the mortgage company's name, current market value. Again, we're going to discount that by 20%. So really, we've got $100,000 of home equity here. If you had a second property, you would put that here, same details. And if you had an attachment, you would create that attachment. You would list all properties. So if you're like a if you're a landlord with a portfolio of properties, you'll probably have your own book that kind of has this information in it. But John and Mary don't, so that's the only property they're listing, and they've got $100,000 of equity here that the IRS would recognize. Now we're going to go into vehicles. This is going to constitute line 6. So we've got 2 vehicles. John's got a Ford F-150, bought it in 2021, 50,000 miles. Got the license plate number. You can put the name of, let's see. Let's just say the date of the last payment is, and then let's say that the monthly lease amount is $500. So the current value is X amount of money minus the loan balance. We could call this, call it $10,000 loan balance. So really this would be $6,000. That's what it would look like if you had a loan. I originally completed this with no loan on it. So we're going to take all of this information out because I don't want it to trip me up when we do our calculations at the end. So Mary has a Toyota Camry, bought it a year later. Again, they have this free and clear. So let's go ahead and just go through this. You'll notice under line 6A and 6C, you subtract $3,450. This is kind of a discounting convention that the IRS places on vehicles. So if you had to sell this vehicle, IRS kind of states you probably would get less money than what the Blue Book value is. We'll go ahead and just discount this by another $3,450. Where they get that figure from, I have no idea. I do think it's adjusted every blue moon or so for inflation, but I can't be sure. So we're going to take any attachments. You would list any total, additional vehicles. You would put the same thing on an attachment, list that here. But we're going to put lines 6B, 6D, and 6E. Be sure not to include lines 6A and 6C since lines 6B and 6D actually just use the same information with an adjustment. So we're going to use this number, and we arrive at the 25,100 number. All right, we've got it for line 7. We've got valuable items. In this case, we've got a Mona Lisa painting. We've discounted it by 20%. If you had anything on loan, you would put the loan balance here. But it's not just, it could be artwork, it could be collections, jewelry, something in a safe deposit box, company interest, or business interest that's not publicly traded. So if you had like a partnership ownership that you weren't really involved in, but you had a stake and it had some value, you would report it here. Furniture, we're going to report furniture here, and we'll just say that they have $10,000 of furniture. So keep in mind that the IRS doesn't need you to provide a complete, inventory of everything you have. Like, you don't need to label all of your clothing unless you have, like a valuable fur coat. They're looking for big ticket items. They don't really provide specific guidance on what you should and shouldn't report. But I would say that if you had a $500,000 house and you didn't bother to report the value of the furniture, someone would probably ask. So you should have at least 2 items of personal assets here, unless you live in an apartment and you literally don't have anything of value to your name. But in this case, the IRS would probably look at this and say, okay. Of course, if you have other valuables, you would put them in an attachment. You would, mark that down according to that formula that we're now used to. And then the IRS allows you to take a deduction of $11,390. So when you add these two up and then you subtract that number, we get $4,610. Again, I don't know where this number comes from. I'm sure there's a rational explanation. I just wasn't able to find it before we started shooting this video. So now we're going to add all the items up. And again, don't include any amounts on the lines with the letter next to the number. Round to the nearest whole dollar. So if it's 49 cents or below, you'll round down. If it's 50 cents or above, round up. And then don't enter any negative numbers. If an item is negative, put a 0 on that line. So when we go to lines 7, 6, 5, 4, 3, 2, and 1, we end up with $209,710. So this is known as Box A. These are available individual equity and assets. So I'm going to take a pause right here and just say, if you actually reported something even similar to this and your tax bill is like, say, $10,000, good luck trying to get out from under it. The IRS will probably not accept it. I can't say with certainty because I don't work for the IRS, but I'm just going to take a leap of faith here and say that this would be very hard for someone at the IRS to accept an offer in compromise, knowing that you have a tax bill of $10,000. Now, if your tax bill is $500,000, maybe. We'll see. We'll see how all of this plays out. But again, it would beg the question of, how does someone with $120,000 of income end up in $500,000 in debt in the first place? So the IRS really tries to force you into reporting honestly your assets, just to kind of see if you're blowing smoke or if you're actually creating a financial hardship for yourself by paying off this tax debt. So in section 4, this is only going to be completed if you or your spouse are self-employed. If either of you or both of you are only W-2 employees and no one has self-employment income, you can skip sections 4, 5, and 6 and go ahead and pick up at section 7. We're going to go ahead and go through section 4. We're going to go through the rest of these just to kind of help you understand how this would work. So it turns out that Mary does have a side hustle. She files Schedule C. Schedule C is for self-employment. Schedule E would be supplemental income. So things like royalty income, rental real estate, partnerships, or distributions from S corporations all get reported on Schedule E. And then Schedule F is kind of like Schedule C, but it's for farm income. So in this case, Mary Jane runs a sole proprietorship. She sells brownies out of her house. She's got a nice website. Looks like she pays herself about $1,000 a month. Really, if you're a sole proprietor and you're the only employee, I'm going to guess that this probably isn't that big of a deal, but I would put something here just to kind of let the IRS know that you're taking this seriously. I mean, even if you're a sole proprietor, you still do have to pay taxes. And as we go through this, she's profitable, so she should be paying something. She could be paying quarterly as a Schedule C filer, but she chooses to pay monthly. So she does business as MJ Brownies, and she doesn't have any other business interests. So we'll go ahead and skip down to section 5. So for this convention, we're going to continue on. Again, this is business asset information, but it looks very similar to the cash and investments portion where, she has $10,000 of cash at Acme Savings Bank. This is her business account, so it's a different account number. You would list the different banking accounts that your business might use. If your business has digital assets, you would list them here as well. If you have an attachment because of overflow, you would enter that here. We've just got $10,000, so we're going to use that right there. And it turns out that she also has $10,000 worth of brownie making equipment. So it's whatever equipment helps you operate your business. So in this case, $8,000 because we've discounted it by 20%. But you would put whatever next description of assets. If you had to use an attachment, you would do that as well. Again, 80% of all the market values minus any loan balances. So in this case, she's got $8,000. This right here, this line is an IRS allowed deduction for professional books and trade for individuals and sole proprietors. So I couldn't find anything in the OIC or the offer and compromise guidance. I couldn't find anything on the IRS website or anything online that was more recent than 2022, I think, was the last time someone, and that was a tax software company, updated a deduction for books and tools of trade. Generally speaking, the IRS would consider a deduction for things that would be consumed. So if you wrote off a library of books, let's just say that you wrote off a library of books, you could put that deduction here. Like, yeah, I've got $8,000 of books, but they're not really $8,000 worth of books because I already wrote them off. They're really, they're worthless if we were forced to sell them. And then tools of trade. So you can use the whatever you might have been allowed to use in the past and put that deduction here. In this case, we're just going to keep it clean. I mean, we could probably put $8,000 here and just say that Mary Jane depreciated or deducted the cost of her brownie making equipment, so she really doesn't have any assets. You could do that, and that might be something worth doing. For the illustrative purposes of the video, we're just going to keep this clean. She doesn't have notes receivable, so she doesn't have any like suppliers that she has outstanding orders. She doesn't have any accounts receivable, so she doesn't have any customers that. Sorry, the notes receivable. She hasn't issued a note to anyone, so and she doesn't have any accounts receivable, so no accounts that she would be charging for future, like invoices or anything like that. So we've just got the cash and we've got the business interest, and that runs up to $18,000. And that's known as box B, which is the available business equity and assets. So boxes A, box B, we've got a few more boxes to come to, and then we'll start putting things together. So in section 6, again, if you're not a sole proprietor, you don't have to use this. If you're just a W-2 employee, you can skip this completely. And another shortcut is you can choose the period. It should be relatively current. But if you have a profit and loss statement, you can attach your profit and loss statement and then simply put in line 17 and line 29 and then net the difference. So this is your income. And again, this is monthly income. So you can average out your monthly income. And so I actually did this incorrectly. So we're going to go ahead and fix this, and we'll have to fix this down below. So I put that she makes $10,000 a month. I actually meant that she made $1,000 a month. And then, well, we'll call it $2,000, and she's got a month, $1,000 a month of supplies. And since she's attaching the profit and loss, we don't need to put all the details here. So we're going to use $1,000 here, which means we'll do some recalculations once we get down further on. Because that's actually going to change our offer and compromise calculation. So Section 7 is the monthly household income and expense. So if you skipped sections 4, 5, and 6 because you don't have a side hustle or a business, this is where you would pick back up. So in this case, so John Doe, he's got $10,000 of gross wages. So that's all he's got. This is monthly income. So $10,000 of income. He doesn't have any of this other stuff. Mary Jane Doe has $1,000 of her self-employment income. So that's $1,000. If you had other sources of income like interest or distributions, rental income, child support, alimony, a non-liable spouse, so someone that's like kind of helping out with the bills, any of that stuff would go into the appropriate lines here. In this case, they don't have any of that. So we're going to total these lines up and we've got $11,000. That's box D. And then we're going to now balance that with our monthly household expenses. And so this is kind of where the IRS will, do a little bit of scrutiny. There's a cheat sheet right here. You can go to the financial standards right here if you wanted to. I'm going to see if I can't open it in a new link, I don't think here. But if you did want to check that out, you can go to that website. So I'm going to see if I can do that in another page just so that we can kind of see what that looks like. So here's the IRS page, the collection financial standards. And if you want to know what they will allow, there's national standards for out-of-pocket based on locality, based on every single different, type of expense. So housing and utilities, transportation. So whatever you put here, that's well and good. The IRS is going to basically allow, whatever the financial standards say that they can allow. So you can say, oh, $11,000, I really need to get this number down to a manageable amount because I've done the math ahead of time and I can figure out how to game the system. And maybe you put like $5,000 worth of food and other stuff. They're going to go back to the standards and they're going to say, oh, okay, what are the food, clothing, and other item standards? And then you would download the standards. And this is what it would look like for a 3-person household. So 1677 for all of the allowable standards. They're going to say, great, we'll cross this out and we'll put 1677. So I guess a pro tip would be make sure you don't shortchange yourself by putting in your expenses. So if you think I only spend $500 on food, go back here and say, are you sure you don't spend closer to $1,000? Because that's what the IRS is accepting. That would be acceptable as long as you're telling the truth or you using reasonable estimates. So if you know for a fact that you're only spending $500 a month for food, then you should probably put $500 a month for food. However, if you're just kind of eyeballing it or using a rough estimate, then you can reasonably use these standards as a go-by. So let's see, housing and utilities. If we went back and we wanted to look at housing and utilities, then this is actually based on states and counties. So, a reasonable standard for a family of 3 is going to look a lot different than, in Alabama than it would in, we'll pick California. We don't need to scroll all the way down to Texas, but let's just say San Francisco County looks a lot different. So again, use this as a helpful guidance. But when it comes to housing and utilities, the IRS, if you claim more than the allowance, then they'll probably ask for documentation. If you claim roughly around the allowance, they might still ask for documentation. So just be truthful and honest and make sure that at the very least, if you have documents that prove otherwise, then you should probably lean towards those documents. Like if you use the national standards and it turns out that the IRS is going to ask you for documentation and your documentation doesn't support it, you might get yourself into a little bit of, trouble. Not trouble, but you might find some adjustments that don't go in your favor. So we just put what we thought might be reasonable costs down here. Again, I would verify this against your actual records and against the applicable standards. So we get all of these items, we put them in here, and then we tally them up in box E. We get $5,200. And now we're going to subtract box E from box D, and we get $5,800. So this is now box F, and that's going to help us figure out our minimum offer amount. So, all right, this is kind of a handful. The first thing I'm going to do is make this adjustment that I needed to make before. All right, so there are a bunch of different moving pieces here, and there are two types of scenarios. So scenario one, if you go to the form 656, it contains what's known as a lump sum payment, which is quantified as 5 or fewer payments within 5 months or less. So you can do this and you'll have a different calculation that results in a lower offer and compromise amount. And if you want to know the formula, it's literally right here. You take your box F amount, which is basically your monthly income minus your expenses, multiply that by 12, and this is what's known as future remaining income, box G. Now, your future remaining income will be different if you pay this in the lump sum category, which is 5 or fewer payments over a period of time that is 5 months or less, than you would if you paid it from 6 to 24 months. 6 to 24 months, that's not the lump sum payment, but you're going to calculate your future remaining income. Instead of multiplying your box F amount by 12, you're going to multiply that by 24. So instead of 69,600, we get 139,200. And then we simply tally box A plus box B, and I believe the total should be 222,710. Let me just double check real quick. Box B is 18,000, and then box A is 209,000. Oh, so I'm gonna have to make that adjustment. Let's see. I think I might have. Oh, okay. Uh-oh. So I'm gonna have to go back and re-enter all this information, but I'm not going to for the purpose of this video. What we're going to do is we're going to take the information that I know to be true, which we ended up with, let's see, I think this was, well, sorry for the inconvenience. You can recreate this how you want, but let's imagine that your box F amount, which is your monthly income minus expenses, is $5,000. It's a nice, neat number. We'll use $60,000 here. If you chose to pay it over a 6 to 24 month period, then it would be $120,000. So depending on what your payment terms are going to be, let's just say that it's $60,000 here. And then we're going to take the total amount of business assets plus the total amount of the personal assets, and let's just say that that was, I think it was somewhere close to $200,000. I know it was slightly more, but we're going to add these two together, and our offer and compromise has to be more than zero, but this would be the calculated offer amount. So again, for someone that's like a mid, we've got one spouse that makes low six-figure salary. The IRS probably isn't going to consider an offer and compromise for a $5,000 to $10,000 tax bill. This is for like significantly steep taxes, people that are woefully behind, and the IRS is going to hold them to the accountable to it. So just kind of keep that in consideration. Again, everything to this point on Form 433A, it's just within your computer. You haven't filed anything yet. So when you do all of this, if you get to an offer amount that just looks ridiculous based on your situation, you might want to take a step back and say, let me see if I can find another route. And this is the IRS's way of kind of telling people to self-select out of submitting an offer and compromise. Now, Section 9 contains a series of yes/no questions that the IRS needs in order to consider whether or not you're able to settle your tax debt for less. Now, up front, it says if you or your business are in a bankruptcy proceeding, then you're not even eligible. So if you're in the middle of bankruptcy proceedings, the IRS is going to wait for you to come out and have that in the rear view where everything is finalized and the case has been, either discharged or dismissed or filed and finalized before they say yes or no to anything that you submit. If you select no, just go on to the next question. So have you ever been involved in litigation? No. Or are you currently a party in litigation? For anything that you're having to fill out the requisite field. So we'll just walk through this because there's a series of questions. Have you ever filed bankruptcy in the past 7 years? Have you ever lived outside the U.S. For 6 months or longer? Have you ever been involved in litigation with the IRS or the United States government, to include tax litigation? They're specifically looking for tax debt, tax litigation. Have you ever been to tax court? Things of that nature. Are you the beneficiary of a trust, estate, or life insurance policy, including overseas? If so, where is that document? Is it a trust or an estate with an employer ID number? What's the name of it? How much would you expect to receive out of it? Again, this is the IRS forcing you to kind of be forthright with everything, wherever it may be. Are you a trustee? That means do you have financial control over a trust? Even if you're restricted by the trust documents, the IRS still just wants to know if you're a trustee or a fiduciary. Do you have a safe deposit box? So as you can tell, the IRS is really trying to eliminate excuses for people to hide money or assets. Have you transferred anything in the past 10 years for less than full value? i.e., did you gift something to a friend? Did you gift it to a family member? When did you do it? Does this look suspicious? These are all questions that the IRS really wants to get an answer to before they say yes or no to any offer and compromise. Do you have any assets outside the U.S.? Do you have any funds being held in trust by a third party? Below that, you and your spouse will sign and date the form. And then right below this, here's a list of all the different attachments that you should be filing with your collection information statement. So pay statements, most recent statement for every account. So investment, retirement account, all of your sources of income, bank statements. If you have a business interest, then you need to complete the form 433B. If you have loans that you reported, you need to put those statements, lists of accounts receivable, notes receivable, child support and alimony payments, actual court orders or copies of, verification of any delinquent state or local tax liability if you reported it, trust documents, estate documents would also apply here. Explanation of circumstances. So if you're saying that you can't pay because of special circumstances, then you need to provide the supporting documentation. If you have an attorney or an accountant or an enrolled agent representing you and you've appointed them on IRS Form 2848 and you don't have a current form on file with the IRS, then you should attach a copy of it and make sure that all years and all forms involved in your offer are listed on your 2848. So if John and Mary Doe were going to assign this to their accountant, they would say, okay, let's go back to all the years that the IRS is trying to collect, whatever that might be. That's not on this document, but it would be in your tax records. And then you would say, power of attorney includes representation on Form 433, Form 1040, because we're talking about their individual tax returns, and Form 656, that's the offer and compromise statement. And then an actual signed current copy of your Form 656. So this is a mouthful, and I apologize for the disruption in the toggle. That's kind of a mouse error on my Mac mouse. But hopefully you get the point. If you have any questions, please post them in the comments section. If for some reason the math didn't add up, I totally understand. Point it out, and I'll make sure I put a note at the very top for people that want to watch the video so that they can understand what they're up against. We'll put links in the show notes to not only the article that goes step by step into this, but any other articles and videos we've created on forms and topics that might be relevant to this. So if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our channel. And as always, if you have any questions or comments, or if there's another topic that you'd like to see in an upcoming video, please hit us up in the comments section. Thank you very much and have a great day.